Broad-based sell-off on Wall Street following Moody's downgrade of several regional banks. The U.S. volatility index hits the highest level since late May. European markets too ended lower as Italian banks lead the losses after a surprise windfall tax announcement. Stocks in the Asia-Pacific open mixed. Retail inflation in China reported a 0.3% drop, while producer price index fell 4.4% in July. The Gift Nifty suggests an absolutely flat start for the Indian market. And oil price is steady, with Brent trading at levels of around $85 a barrel despite bearish China crude export and import data. Gold prices dropped nearly to a one-month low as the US dollar rallies. In important earnings to track this Wednesday, you have Tata Power, Z Entertainment, Berger Paints, Bharat Forge and IRCTC, which are all expected to report their first quarter numbers through the day. EV giant Tesla is likely to announce its India roadmap by the end of 2023. Government sources say that Tesla might first set up a supply chain ecosystem in India before starting manufacturing. The government is working on a policy framework that encourages the company to start making in India. Hi guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are the top headlines that we have for you this Wednesday morning. There's a lot that has happened in terms of global action, so let's start with that. And taking a look at the Asian markets, is looking quite mixed. The Hang Seng is down once again, so that one is now seeing cuts of around 0.25%. Not too bad, but for the week we've already seen a near 2.5% cut on the index, so do keep your eye out on that. The Taiwanese market seems to have recovered, so that's up almost 0.2%. Nikkei seeing cuts of around 0.25%. Again, you have the Shanghai markets, which are down at similar levels. So not too much in terms of losses coming through, but it is quite a mixed open. You have the Kospi also, which is trading quite well. That's actually the market which is perhaps looking the best this morning. That's up around 0.9%. And the Straits from, the Asian markets is shut on account of a holiday. So do keep that in mind. The Gift Nifty indicates that the start for our own market will be absolutely flat. There you have it, just around 1 point lower is where we're at. So absolutely flat start, but let's see how things go from there. We did end with cuts of around 25 points, so it'll be interesting to see how the day shapes up. But speaking of Asia, let's also talk about China's July CPI data, which softened for the month of July. So it fell 0.3% if I look at it on a year-over-year basis. We have CNBC's Sam Vadas, who's here with us to take us through all of those numbers. Sam.
For the July CPI, we've come in down 0.3% year on year. So that is slightly better than a Reuters poll, but the sticker prices have now slipped into deflation. So that was actually up 0.2% from the previous month. So month on month, we have seen a slight improvement there. The PPI, the factory gate prices, we've seen the 10th month of deflation now at minus 4.4%. That was slightly worse than a Reuters poll, but slightly better than what we've seen in June. Month on month, that PPI also slipping 0.2%. So in terms of the food CPI, down 1.7%. This is in terms of the breakdown as to what got us to that headline number. And non-food CPI was flat, so no change there. This largely has been in recent months a story of falling non-food CPI prices. So we continue to see that reflected certainly in the numbers today.
All right, Sam, thanks a lot for breaking down all of those numbers. But speaking of that, let's also bring you some opinion from former Morgan Stanley Asia Chairman Stephen Roach on the Chinese macros, as well as the outlook for the economy as he sees it. Listen in.
The fundamentals of the Chinese economy, which are terrible right now. The trade data that was released overnight, it's not just that exports were down, it's that imports were down much more sharply than expected, which indicates that the weakened state of internal or domestic demand. China increasingly has more of a Japanese-like problem with an aging workforce and weak productivity and a debt-intensive response to these problems, which borrows a page right out of Japan's script. So they've got very serious problems to address, and the policy actions that they seem to be taking right now do not appear to be forceful enough to address this problem. At the onset of the trade war, China accounted for 47% of our total merchandise trade deficit, and now the number is 32. So we have decoupled, whether they want to call it that or not. And these actions, along with Mike Gallagher's ill-informed efforts to decouple capital flows, I think will exacerbate problems in the United States and lead to further conflict with China.
All right, that is the word coming in from Stephen Roach. By the way, speaking of the macros, this week is very important because we also do have the US CPI data, which is expected later in the week. So that is going to be an important cue to track as well. But speaking of the US markets, we had Wall Street, which ended yesterday's trading session lower on the back of credit rating agency Moody's, which went ahead and downgraded 10 US banks. So the Dow lost nearly 160 points, like you can see on your screen. The S&P 500 dipped around 0.4% at the close, and the Nasdaq was down 110 points. We have Kate Rogers, who's here to bring us the complete wrap of the action that we saw on Wall Street. Kate.
Markets were in the red Tuesday as a downgrade of the banking sector led to an August sell-off. The Dow down 159, the S&P 500 off by 19, and the tech-heavy Nasdaq lost 110. Credit rating agency Moody's cut the ratings of 10 U.S. small to mid-sized banks and said it could downgrade some of the nation's biggest lenders. Moody's put 6 banks, including Bank of New York Mellon, U.S. Bank Corp, State Street, and Truist Financial, on review. The cuts come as Moody's warns about lower profits and higher funding costs. American credit card debt topped $1 trillion for the first time ever. But according to the New York Federal Reserve, overall household debts were relatively unchanged. Fed researchers said despite higher interest rates, inflation, and recent banking failures, the report produced limited evidence that Americans are in financial distress. That's what's happening here in the U.S. Back to you in Mumbai.
All right, Kate, thanks a lot for getting us all of that action. But the big news from the U.S., like we were pointing out, is clearly that Moody's downgrade of 10 U.S. banks. So let's go across to Mike Santoli on what the bank's downgrade really means and the likely fallout for the U.S. banking system. Mike.
At least a condition that in the past has been associated with other banking stress events. This is the very wide spread, unusually wide, between the 30-year fixed mortgage rate and the 10-year Treasury yield. Right now, 30-year fixed mortgage national average, a little bit above 7%. We got 4% 10-year Treasury yields. You see that 3 percentage point spread really only reached right there in the height of the global financial crisis and got close right there in the COVID crash. Typically, it's more in the zone of like the high, 1.8, just under 2 percentage points difference. Now, a few things going on. One is just the velocity of this increase in yields, in Fed funds that we've seen over the last year or two that has sort of a lot of lenders a little bit hesitant to extend credit out 30 years. Obviously, also the bank capital issues, the fact that they have unrealized losses in their bond and mortgage portfolios already, that's keeping more banks from going out there and either buying mortgage-backed securities or lending at a tighter spread. And naturally, the Fed is reducing its balance sheet. It's kind of reducing its holdings of mortgage-backed securities. The net effect of it, of course, is that you're having a little more restriction on housing demand than you otherwise would, given the state of the economy and credit conditions more broadly. And obviously, it's something that you can't have a quick fix for unless you just have more reassurance that yields are not going to flare up and that the economy is going to hold together.
All right, Mike, thanks a lot for explaining that to us. But let's also listen into the reaction that we got on this entire episode by Moody's. This is from Eddie Ardini. Listen into what he had to tell us.
Banking crisis started on March 9th and 10th. On March 12th, which was a Sunday, the Fed came in with a liquidity facility that seemed to save the day. But Moody's is reminding us that all is not well in the banking sector, that they still have credit risks on their loans, particularly their commercial real estate loans. And that's especially true for the smaller banks that have made a lot of loans in the real estate sector, in the commercial real estate sector. But I think that there really isn't news, but the market did sell off on it. It came as a bit of a surprise. But I think, on the other hand, it means that the Fed's probably not going to be raising interest rates anytime soon.
Okay, he doesn't see the Fed raising rates anytime soon. That is the word from Eddie Ardini. But with that, let's move on and bring you the final update in our global market wrap this morning. European markets also ended Tuesday's trading session lower. So we had the French CAC index, which was down around 50 points at the close. The DAX lost 170 points, and the British FTSE index closed with cuts of around 27 points. Now, the big news that really came through is that shares of Italian banks fell between 5% to 9%. This after the government announced a surprise 40% windfall tax on banking profits. So that was was quite an unexpected move, and it led to these cuts that we've seen in the markets. The broader Eurozone banking index fell over 3.5%. This is perhaps the worst day that we've seen since March for the index. And on the macros also, there was some news flow because the inflation number in Germany eased to 6.5%. This is for July versus the 6.8% increase that we had in the month of June. So that is some important cues coming out of the Europe region that, you should keep your eye on. But with that, we do need to get into a short break. We've taken you through how the global markets really did. But on the other side, we're going to break it down and tell you about all of the cues that you should track for our own markets. Stay tuned for that. Welcome back. You're still tuned into Power Breakfast. Let's now talk about all of the cues that you should track before we get into this market open. We have Ekta, Nigel, as well as Vivek joining us to take us through the trade setup. Guys, a very good morning to all of you. Ekta, coming to you first. We ended with some cuts yesterday, but take us through everything we should watch this morning. The global setup also looks a bit weak.
Thanks for that. Well, yes, you did mention the global setup quite, in a very distinct manner. So we did have the US markets which closed lower as Moody's downgraded several regional banks overnight. We have Asia, which is mixed as China's CPI has fallen for the first time in 2 years. Oil has edged higher as well. So the global picture is looking a little tentative at this point in time. The Gift Nifty, the implied open is indicating a little bit of a negative bias at this point. Let's see whether there's any sort of buying at lower levels. In terms of the FIIs, they net sold over 700 crores in the cash market yesterday. 9 consecutive sessions of selling now. But the DIIs have net bought for 4 consecutive sessions. So they net bought around 537 odd crores in yesterday's trading session. This trend and how it basically corroborates with our market is something that we need to watch quite closely. Now, the markets will be focusing on the macros versus micros as the earnings season is coming to an end. So we have the US CPI data on Thursday for July. We have the RBI policy on Thursday as well. The RBI is likely to hold rates. And we have the India CPI data on Monday as well, which is on the 14th of August. So we have a lot of macros lined up in the next couple of days. The 20-day moving average stands at 19,638.4 for the Nifty. So that'll probably be the next port of call in terms of sustaining at those levels. And in terms of earnings, we have Tata Power, Zee, Bharat Forge, Berger Paints, IRCTC, PI Industries, all of them that will be reporting numbers today. So we will have a lot of focus on the broader markets especially.
All right, Ekta, thanks a lot for taking us through all of those cues. In fact, speaking of earnings, there were a whole bunch that came through post-market close yesterday as well. So Vivek is here to bring us up to speed with how they really looked. Vivek.
Well, good morning. A lot of numbers, a lot of companies declared their results as far as Q1 is concerned. We'll take you through the major ones and how exactly have they panned out in terms of both year-on-year performance as well as some commentary on how exactly they fared against what the street was anticipating. Coal India, very good set of numbers against what consensus was estimating. On a year-on-year basis, while revenues were higher by 2.5%, the core EBITDA went down almost 14.5% and margins too slipped over 500 basis points. On the back of that, net profitability was down 10%. Now, the next number that we're looking at is Siemens, a slightly mixed quarter from the company. While the numbers were largely in line with what the street was anticipating, the margins missed by over 100 basis points, and that would be a slightly concerning figure. However, the order wins that the company saw was well in excess of 5,200 crore, and that continues to be a solace. Now, talking about the numbers themselves, revenues higher by 14.5%, EBITDA, core EBITDA up almost 37.5%, margins too coming in stronger compared on a year-on-year basis, 11.6 versus 9.7 last time around, and profitability higher by over 50%. Birla Corporation is a cement company delivering a steady operational performance. Volumes jumped up almost 12.2% on a year-on-year basis. The core EBITDA up almost 15%, and when you're talking about the margins up at coming in at 12.4%. Brigade Enterprises, the lumpy nature of this particular company in terms of earnings deliverance continues. While revenues were down 27%, the core EBITDA was down almost 25% on a year-on-year basis. Margins coming in at 26.7%. Profitability, however, went down almost 56%. Again, this on a year-on-year basis. Aarti Industries, most of the chemical companies are delivering a weak Q1, and Aarti Industries was no exception. While you're talking about the revenues down 12.2%, EBITDA down 28.9%, margins to over 250 basis points lower, and profitability down 48%. And lastly, one company to keep on the radar on the back of news flow, SBI Life, IRDAI has gone ahead and approved the appointment of Amit Jangran as the MD and CEO of the company.
All right, Vivek, that's really a lot for us to track, but thank you for compressing all of that information and bringing it to us. Let's finally move over to Nigel. He's tracking all of the cues from the futures and options space. Hi, Nigel.
Well, morning, Pavitra. Well, let's take a look at the FNO action first. What do the FIs do? They lighten their positions both on the long side as well as on the short side. But the short side, they covered far more. So close to around 7,400 contracts is what they've covered. Though they continue to remain net short, but close to around 53% of their positions on the short side. Now, in the last few days, the FIs, they have been net short, but that's gradually come down. So from around 40,000 net short contracts, that's come down to around 12,000 contracts out. So some part of that short covering from around the 19,300 odd has already played out. Now, on the option side, the 19,600, 19,650 call, between them, they added more than 90 lakh shares, telling you that the 19,650 level, that's going to be the near-term hurdle for the bulls. The Nifty Bank as well, that's going to be important. But before we get to the Nifty Bank, just focus on the Nifty levels. The 20 DMA or the 19,650 mark, as I mentioned, that's a resistance zone. On the downside, though, we are seeing a fair bit of open interest built up at around the 19,500 put, and that has the highest open interest on the put side. So that's why we're seeing some kind of support at around 19,460. The Nifty Bank as well. Well, yesterday it showed some kind of signs that it wanted to go to around the 45,000 odd mark. But I think on the downside, the 50 DMA, around 44,600 odd, that becomes a crucial mark. We saw some writing at around the 45,000 put as well. So that becomes important. But global Q is a little bit muddled. So that's why we start off on the back foot. And let's see how it goes from there. Back to you.
All right, Nigel, thanks a lot for bringing us all of those cues. With that, we do need to get into a short break. But on the other side, we're going to shift focus to the world of commodities and tell you what's going on there. Manisha will be with us in just a bit. Welcome back. Let's talk all about the commodity markets now. We have Manisha with us as always to fill us in with all of the important updates that have come through overnight. Manisha, what are you looking at this morning?
Pavitra, I'm looking at the crude oil prices, which are trading at a 4-month highs yet again. So we continue to hold above $85 a barrel, even 86 right now for the Asian markets. The EIA monthly data that came in yesterday suggests that the global supply deficit for 2023 is what they have forecasted, and that has lent to some support into the markets. Also, the street is waiting for the U.S. inventory data that comes in today, with expectation that the U.S. inventories may have risen, but the product inventories may show a decline because of demand increase, and that has been supportive. In the meanwhile, the metal prices have continued to decline. The strength in U.S. dollar, the weak China trade data, the weak China inflation numbers, all of that seems to be weighing on. So you have copper prices trading at a 1-month lows, steel is trading at a 2-month lows, and it's a 1-month low for gold and silver as well. So quite a bit of profit taking when you look at metals as a sector.
All right, Manisha, thanks a lot for getting us all of those updates as far as commodities go. In fact, sticking with that, let's also listen to Dan Yagan, Vice Chairman of S&P Global, on where he really sees oil prices heading this year. Listening.
Right now, the view out there is that it's sort of 85, mid-80s. I think for that to happen, I mean, it is seen that the oil market is tightening. OPEC Plus has been holding back supplies, but you haven't gotten the rebound in China. I think you'd need to see a stronger rebound in China to continue to push up oil prices higher. So I think it's, and I think the other factor that's out there that's discounted is where does this war in Ukraine go? If the Ukrainians say the Russians are waging economic war against them by attacking their grain supplies and system, well, the Ukrainians may well start attacking, as they started to do, the Russian supply system. So that's a wild card out there that certainly could also affect prices.
All right, that is an important word coming in on where the oil prices could be headed. But with that, we're going to wind down on this edition of Power Breakfast with the news that Asia is not looking too good. It has slipped a little bit more in the time that we have been talking. The Gift Nifty implies a flat but perhaps a slightly negative start for the Indian market. 7 points lower there. Thank you for tuning into Power Breakfast. We have Bazaar Morning Call up into.